Ladies and gentlemen, if you've been in the markets long enough, you've probably searched endlessly for that perfect entry, that flawless setup, that one strategy that never fails. We all start there, believing that somewhere out there, hidden in a chart pattern or buried in an indicator, is the secret to consistent profits. But the truth is far simpler and far more uncomfortable. The one strategy that works every single day has nothing to do with the market and everything to do with you. Because the market doesn't need to be predicted. It doesn't owe you certainty. It doesn't reward brilliance, and it will never become easier just because you want it to. The market only rewards one thing: a trader who has mastered their own mind. Consistency isn't built on knowing what will happen next. Consistency is built on knowing how you will behave no matter what happens next. When you can act without fear, without hesitation, without the emotional baggage of your last trade, you stop trying to force the market to give you what you want. Instead, you let the probabilities play out. You take your edge every time without distortion. You protect your risk because you understand that anything can happen, and you let your winners unfold because you're no longer trying to control an outcome. This mindset, this internal strategy, is the only thing that works every day, in every market, under every condition. When you master yourself, the market becomes a place of opportunity, not threat. When you embrace uncertainty, you stop fighting the flow and start riding it. And when you approach each trade with clarity, confidence, and emotional neutrality, consistency stops being a dream and becomes your natural state. Today, we're not here to sharpen indicators. We're here to sharpen the one thing that truly makes you a trader: your mental edge. The only strategy that works every day is mastering your own mental framework, trading from a mindset of consistency, not prediction. And this truth sits at the core of every successful trading journey. Most traders spend years searching for certainty in a world where certainty simply doesn't exist. They search for the perfect system, the perfect indicator, the perfect formula that promises a fixed outcome. They chase patterns as if patterns guarantee profits. They hop from method to method, from strategy to strategy, and with every loss they question the validity of the tools they use rather than questioning the state of mind that uses them. But the secret that separates consistent traders from struggling ones is painfully simple. The only part of the market you can ever truly control is yourself. When you understand this deeply, not intellectually, but emotionally, you start to realize why so many traders fail despite having access to the same charts, the same data, and the same opportunities that others use to build fortunes. The difference isn't the system. The difference is the mindset operating the system. Two traders can use the exact same strategy. One will make money with it, and the other will lose. The strategy remains unchanged. The market remains unchanged. The only difference is the mental framework through which each trader interprets and responds to market information. This is why mastering your internal world becomes the only strategy that works every single day, regardless of volatility, news events, or market conditions. Developing this mental framework begins with accepting a fundamental truth of trading: anything can happen. Once you accept that no analysis, no expert, no indicator, and no algorithm can ever guarantee the next tick, you stop trying to predict the future and start positioning yourself to respond effectively to whatever the market reveals. This shift liberates you from the emotional roller coaster of hope, fear, and frustration. When you stop demanding that the market behave a certain way, you stop creating emotional conflict within yourself. Suddenly, you become available to see the market as it actually is, not as you want it to be. Once you internalize uncertainty, probability becomes your guiding principle. You begin to understand that your edge is not about being right on each individual trade. It's about having a repeatable process that produces favorable outcomes over a series of trades. Instead of trying to be right, you focus on being consistent. Instead of trying to win every time, you focus on executing your plan flawlessly. This shift in focus, from outcome to process, is the foundation of the mental framework that truly works every day. But to maintain this mindset, you must confront the emotional impulses that disrupt your consistency. Fear of loss convinces you to hesitate. Fear of missing out pushes you to chase trades that don't meet your criteria. Greed urges you to overstay your welcome in the market. Hope leads you to ignore your stops. Every one of these emotional reactions comes from a belief that the market should give you something: confirmation, reassurance, perfection, or reward. And every one of these beliefs blinds you to the reality of probability. Mastering your mental framework means dissolving these emotional blocks by redefining your relationship to risk. A trader who is mentally consistent doesn't fear risk because they have already accepted it before entering the trade. They've predetermined their maximum loss. They know exactly how much they're willing to give the market in exchange for a potential reward. They aren't emotionally attached to the outcome because they aren't trying to force certainty out of uncertainty. They are playing probabilities with discipline, clarity, and neutrality. It's this neutrality that marks the turning point. Neutrality doesn't mean indifference. It means you no longer personalize the outcome of a trade. A loss is not a reflection of your worth or intelligence. A win does not validate you as a superior trader. Both are simply outcomes within a distribution of probabilities. When you understand this, you stop oscillating between euphoria and devastation. You begin to operate from a stable emotional center. And from this center arises the consistency that so many traders crave but rarely achieve. Another key part of this mental framework is learning to truly let go of the need to know what will happen next. This sounds simple, but it requires deep mental conditioning. Most traders think they've accepted uncertainty, but their behavior reveals otherwise. They still hesitate, hoping for confirmation. They still move their stops, hoping the market will come back. They still overanalyze, hoping to eliminate doubt. But consistency isn't the result of eliminating doubt. It's the result of functioning effectively despite doubt. When you accept that you will never know the outcome of the next trade, you free yourself to take your setups without resistance. And this is where discipline naturally emerges. Contrary to popular belief, discipline is not about forcing yourself to behave a certain way. It is the natural result of clarity and acceptance. When you are clear about your edge, when you are at peace with uncertainty, when you've accepted risk, discipline becomes effortless. You don't need to resist temptation. Temptation loses its power. You don't need to fight fear. Fear loses its grip. You don't need to force patience. Patience becomes your default state because you no longer feel the emotional urgency to control outcomes. The trader who masters this internal strategy becomes immune to many of the psychological pitfalls that plague others. They don't revenge trade because they don't take losses personally. They don't impulsively chase moves because they understand that opportunities are abundant. They don't freeze when the market moves quickly because they've already accepted that speed is part of the game. They don't cling to trades that violate their rules because they no longer need the market to prove them right. Instead, they operate with quiet confidence, grounded awareness, and unwavering consistency. They take the trades that match their plan and ignore the ones that don't. They follow their rules not because they're forcing discipline, but because the rules make sense to them on a deep emotional level. Their identity is no longer tied to outcomes, it is tied to execution. The irony is that once you stop trying to control outcomes and focus solely on flawless execution, outcomes improve dramatically. Your winners become larger because you allow them to unfold without emotional interference. Your losses become smaller because you respect your stops without hesitation. Your overall equity curve becomes smoother because your behavior becomes more stable. And stability is the gateway to growth. Every trader wants a strategy that works every day, but most overlook the fact that market strategies are variable. Market conditions shift, volatility expands and contracts, trends form and dissolve, sentiment flips without warning. No external strategy can adapt to every environment. But your internal strategy, your mental framework, can. It is the one constant you carry with you into every trade, every session, every market. It is the foundation upon which all long-term success is built. When you learn to think in probabilities, act with consistency, and execute with emotional neutrality, you become the one stable force in an unstable environment. You become the trader who is unfazed by uncertainty, unshaken by losses, and untempted by the illusion of easy wins. You transform from someone who trades from fear and hope into someone who trades from clarity and confidence. And once you reach that level, everything changes. The market stops feeling like a battlefield and starts becoming a place of opportunity. Trades stop feeling like risks and start feeling like decisions. Losses stop feeling like failures and start becoming the cost of doing business. You're no longer trying to extract certainty from a random environment. Instead, you're flowing with the market, responding instead of reacting, observing instead of judging, executing instead of predicting. This is the mental framework that works every day. This is the only strategy that transcends conditions and survives the ever-changing landscape of the markets. Every tool, every technique, every system you use becomes more powerful when operated from this mindset. Without it, even the best strategy fails. With it, even a simple strategy thrives. Master your mind, and the market becomes a different world. Ignore your mind, and no strategy will ever save you. Markets are uncertain, but your responses don't have to be. True edge comes from disciplined execution, not perfect analysis. This simple idea undercuts the greatest illusion that pulls traders into years of struggle. The illusion that if they could just analyze better, predict better, or interpret the market better, they would suddenly unlock consistent results. But the trader who thrives is not the one who seeks perfection in their analysis. It is the one who can act with calm, controlled certainty in the middle of market chaos. The edge comes not from seeing the future, but from responding to the present with unwavering discipline. The market is a living environment, constantly shifting, constantly evolving, constantly surprising. There is no fixed logic that guarantees what will happen next. Analysis can help you understand possibilities, but it can never give you certainty. No matter how advanced your system is, no matter how many tools, indicators, or algorithms you rely on, the market will always retain the final say. And because the market is inherently uncertain, placing your confidence in prediction is a setup for frustration. Traders who cling to perfect signals or flawless setups become emotionally fragile because they are constantly judging their sense of control against a market that refuses to be controlled. This is why disciplined execution becomes your true advantage. It is the one part of trading that isn't influenced by volatility, news events, manipulation, or randomness. You may not control the outcome of a trade, but you control how you take it. You may not control how price moves afterward, but you control how you respond. Most traders don't lose because of faulty analysis. They lose because their actions betray their plan. They hesitate when they should execute. They hold when they should exit. They chase when they should wait. They break their own rules because they haven't learned to trust their process over their emotions. Execution is difficult because it forces you to confront yourself. The moment you hit the buy or sell button, you expose yourself to risk, to uncertainty, to the possibility of being wrong. That moment triggers all the fears and biases that exist within the human mind. Fear of loss, fear of missing out, fear of being wrong, fear of imperfection, fear of inadequacy. These fears distort perception, push you toward irrational decisions, and steal your ability to behave consistently. If you're not aware of these emotional forces, the market becomes a mirror that reflects your inner conflict. Every trade becomes a negotiation between logic and emotion, and unless you master execution, emotion wins more often than not. To execute with discipline, you must adopt a probabilistic mindset. This means accepting that no single trade has any special meaning. Each trade is just one event in a larger series. Your job is not to guess which trade will be the winner. It is to execute your edge repeatedly, knowing that results only make sense when viewed over dozens or hundreds of trades. When you internalize this truth, your emotional relationship to each outcome shifts dramatically. You stop burdening each trade with the weight of expectation. You stop demanding that this trade be the one that works. You stop reacting to every fluctuation as if it matters. You simply take your setups, manage your risk, and allow the distribution of probabilities to play out. The more you think in probabilities, the more naturally disciplined execution becomes. Discipline turns into a natural behavior rather than a forced one. You stop fighting your own impulses because you no longer feel pressured to control the market. You stop questioning your rules because you understand that consistency requires repetition, not perfection. You stop chasing certainty because you no longer need it. What you need, what you truly rely on, is your ability to follow your plan without distortion. Yet this level of discipline doesn't come from willpower alone. It comes from clarity. You must have a clear, detailed, unambiguous trading plan. Many traders think they have a plan, but what they really have is a set of ideas loosely strung together. A true plan removes discretion. It tells you exactly when to enter, exactly when to exit, exactly how much to risk, exactly how to trail a stop, and exactly how to respond to different market conditions. Without this clarity, discipline is impossible because you cannot be disciplined about something vague. Once you create clarity in your trading plan, you must create emotional clarity around its use. This means committing to the idea that your job is not to react emotionally to any single outcome. Your job is to execute your edge. Losses are part of that edge. Wins are part of that edge. You accept them both with equal emotional weight. The moment you try to avoid losses, fight losses, or minimize their emotional impact by manipulating your trades, you destroy the integrity of your own plan. This is why traders who fear loss never execute properly. They cut winners early, widen stops, avoid setups that look risky, or jump prematurely into setups that look safer. They're not executing their plan, they're negotiating with their emotions. Disciplined execution also requires the ability to remain fully present. You cannot trade effectively if your mind is stuck on the previous trade, the previous mistake, or the previous missed opportunity. The market doesn't pause to let you process your emotions. If your mind lags, your execution lags. And when execution lags, hesitation replaces clarity. You hesitate on entries that fit your plan because your mind is replaying the last loss. You hesitate on exits because you're imagining what might happen if you hold a little longer. You hesitate on setups because you're projecting future scenarios that may never unfold. In that hesitation, your edge evaporates. Being present means resetting your emotional slate before every trade. It means approaching each opportunity as if the previous one never existed. This doesn't mean ignoring your experience or your data. It means not carrying emotional residue forward. You act from strategy, not fear. You act from clarity, not impulse. You act from acceptance, not resistance. And acceptance is the foundation of disciplined execution. Acceptance of uncertainty, acceptance of risk, acceptance of imperfection, acceptance of losing trades as natural components of a larger process. When you truly accept these realities, something profound happens. The market stops triggering emotional reactions that distort your behavior. You no longer feel panic when a trade moves against you because you've pre-accepted the risk. You no longer feel euphoric when a trade goes your way because you know the outcome is just part of the distribution. You no longer feel compelled to overtrade because you trust that opportunities are endless. You no longer feel frustrated by randomness because randomness no longer disrupts your internal balance. And this emotional balance is what allows you to maintain disciplined execution consistently. Discipline isn't just about following rules. It's about protecting your psychological capital, your mental energy, your focus, your composure. These are your most valuable trading assets. Without them, even the best system breaks down. With them, even a simple system can produce remarkable results. Disciplined execution becomes your competitive advantage because most traders never develop it. They stay trapped in the cycle of refining analysis rather than refining behavior. They switch indicators instead of switching habits. They adjust their charts instead of adjusting their mindset. They chase the illusion of certainty rather than embracing the certainty of uncertainty. And thus they remain reactive, emotionally inconsistent, and unable to progress. Meanwhile, the trader who prioritizes execution over prediction stands apart. They accept randomness. They trust their edge. They follow their process. They refine behavior, not just analysis. They act with stability in an unstable environment. They build consistency, not through perfect knowledge, but through consistent actions. And because they remain emotionally grounded while others are emotionally volatile, they are able to capitalize on opportunities that others overlook or misuse. The market rewards the trader who behaves consistently, not the trader who analyzes perfectly. Because the market is not a test of intelligence, it is a test of emotional stability. Not a test of prediction, a test of execution. Not a test of strategy, a test of discipline. Once you understand this, once you embody it, once you make it your core philosophy, you unlock the only true edge that remains stable in every condition. The ability to act clearly and consistently in an environment that is anything but clear or consistent. That is where success begins. That is where the uncertainty of the market meets the certainty of your behavior. That is where discipline becomes the foundation of everything you do. A winning trader focuses on probabilities, risk control, and emotional neutrality, turning every market condition into opportunity through mindset. This isn't a motivational slogan. It is the foundation of consistent trading and the essence of how professionals separate themselves from the emotional chaos that traps most traders. The markets move through cycles of fear, greed, uncertainty, volatility, and calm. These shifts are inevitable and unpredictable, yet traders who understand the game on a deeper psychological level know that their edge doesn't come from forecasting these shifts. It comes from responding to them with stability, clarity, and disciplined probability-based thinking. A trader who thinks in probabilities perceives the market in a fundamentally different way than the trader who relies on prediction. Prediction is a rigid mindset. It is the belief that one outcome is more important than others. It is the creation of an emotional attachment to being right. But in a probabilistic environment, being right is never the goal. The goal is to execute an edge repeatedly, knowing that the distribution of results will unfold over time. This shift in focus, from being right on this trade to executing correctly over many trades, is liberating. It frees the trader from the emotional burden that accompanies each individual outcome. One trade becomes just one data point instead of a measure of personal worth or intelligence. When a trader truly embraces probabilities, they begin to understand that any single trade is irrelevant. It does not matter whether the next trade wins or loses. It does not matter if the setup looks perfect or imperfect. What matters is whether the trader followed their process, respected their risk parameters, and executed the setup as designed. This mental framework removes the weight and pressure from every decision, allowing the trader to operate with clarity instead of fear, doubt, or hope. But thinking in probabilities alone is not enough. It must be paired with risk control, another pillar of professional trading. Risk control is the mechanism that prevents the natural randomness of markets from destroying a trader's capital. Without risk control, even a high probability system eventually collapses because markets will always produce unexpected events. The trader who ignores risk is like a ship captain who sets sail believing the ocean will always remain calm. The ocean's nature isn't calmness, it's unpredictability. You don't prepare for calm seas, you prepare for storms. Risk control means defining how much you're willing to lose before you enter the trade. It means accepting that loss fully, mentally, and emotionally, so that if the stop hits, no psychological disturbance follows. A trader who does not accept risk becomes vulnerable to emotional impulses that lead to destructive behavior, moving stops, adding to losers, averaging down, or refusing to exit. A trader who accepts risk becomes emotionally neutral to adverse outcomes. They understand that a predefined loss is simply the cost of doing business. It is not personal. It is not a threat. It is not a failure. It is an operating expense. When a trader integrates risk control into their process, they create a stable psychological foundation. This stability allows them to think clearly under pressure because they are no longer trying to prevent losses. They already accepted them. Ironically, the trader who fully accepts loss is the one who loses the least over time because their behavior remains consistent and rational. The trader who fears loss the most ends up losing the greatest amount because their fear distorts decision-making. The next element, emotional neutrality, is the glue that holds everything together. Without emotional neutrality, the trader cannot think in probabilities consistently, cannot execute risk control consistently, and cannot maintain discipline. Emotional neutrality does not mean removing emotion completely, but rather preventing emotion from hijacking the decision-making process. When traders feel fear, their perception of market information becomes distorted. They see danger where none exists. When they feel greed, they ignore their own rules and take excessive risks. When they feel frustration, they deviate from their plan to make back losses. Emotional neutrality means you observe the market without attaching your identity or self-worth to the outcome. It means you respond to whatever the market presents without projecting your desires or fears onto it. You aren't euphoric when you win, and you aren't devastated when you lose. You remain centered and balanced. You think clearly, act decisively, and follow your plan without hesitation or doubt. That internal calm becomes the trader's ultimate competitive advantage because most traders operate from a state of emotional turbulence. When these three elements, probability-based thinking, risk control, and emotional neutrality, mesh into one mindset, the trader becomes capable of turning any market condition into opportunity. This doesn't mean every condition produces profits. It means every condition becomes manageable. Every condition becomes understandable. Every condition becomes navigable. Opportunities arise not because the market becomes easier, but because the trader's mind becomes clearer. In trending markets, the emotionally neutral trader doesn't chase price or fear missing out. They follow their system and take the signals their strategy provides. In ranging markets, they don't force trades or overanalyze. They simply adapt to the environment or wait patiently. In volatile markets, they don't panic, they rely on risk management. In quiet markets, they don't invent trades out of boredom, they protect their discipline. Opportunity to a professional trader is not defined by market movement, it is defined by mindset. If the trader is centered, objective, disciplined, and consistent, then every condition becomes a potential opening to apply their edge. If the trader is reactive, emotional, or desperate, then even the best market conditions become untradeable, because the trader's mind distorts information. Mindset is the lens through which the trader interprets every tick, every candle, every setup. With the wrong lens, the trader sees threat, uncertainty, pressure, and confusion. With the right lens, the trader sees possibility, structure, probability, and flow. The market stays the same. Only the trader changes. The trader who focuses on probabilities no longer tries to interpret the random as predictable. They accept the randomness and work within it. The trader who focuses on risk control no longer fears the unknown because the unknown is already accounted for in their risk parameters. The trader who focuses on emotional neutrality no longer fights their own impulses because their mind is trained to remain steady, regardless of outcome. All three elements combine to create a state of peak trading performance, where the trader moves effortlessly between action and patience, confidence and caution, aggressiveness and restraint. They know when to press their edge and when to sit out. They know when the market environment aligns with their strategy and when it doesn't. They treat trading as a business, not a gamble, as a probabilistic decision-making process, not a crystal ball. This mindset becomes even more powerful when the trader realizes that the market doesn't provide consistency. They do. Market conditions change constantly. There's no reliable pattern the market will repeat every day. There's no signal that works forever. There's no strategy immune to shifting dynamics. But the trader's mindset can remain consistent, and that consistency becomes the anchor that allows the trader to navigate the uncertain ocean of the markets with confidence. Once the trader internalizes these principles, their entire trading experience transforms. They stop chasing certainty. They stop reacting emotionally. They stop attempting to control the uncontrollable. Instead, they start managing themselves, which is the only part of the game they truly have power over. And because they manage themselves, they can approach every decision with calm, focus, and intention. Every market condition becomes an opportunity, if not to take a trade, then to observe, to learn, to refine, to improve. Volatility becomes a playground rather than a danger zone. Calm periods become opportunities for planning and review rather than boredom traps. Losses become data rather than emotional blows. Wins become reinforcement rather than ego boosts. The winning trader knows that their mindset is their real strategy, their thought process is their indicator, their discipline is their entry signal, their risk control is their safety net, their emotional neutrality is their edge. When the trader masters these internal tools, they no longer fear the market because they no longer fear themselves. And when they no longer fear themselves, they can finally trade with confidence, clarity, and consistency, turning the ever-changing market into a landscape of endless possibility. In trading, the market's uncertainty is inevitable, but your mindset doesn't have to be. True consistency comes from thinking in probabilities, controlling risk, and maintaining emotional neutrality. By mastering these internal tools, you transform every market condition into opportunity, acting with clarity and discipline rather than reacting with fear or hope. The real edge isn't in prediction or strategy alone. It lies in your ability to remain centered, execute your plan consistently, and trust the process. Success comes not from controlling the market, but from mastering yourself.